Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media like we normally do. I'll interject my financial opinions, generally related to three different topics: wealth building, commodities, and or financial topics. So let's get in there. Let's see what people are sharing, and I'll share my opinions. If you want to follow me, it's at Finance. And if you want to join our community, finding-value.com is where I dive deeper into these topics. I give you my opinions, my strategies, how I'm playing this commodity bull market, the companies I'm playing it with, why I'm going into them, the fractals and the technical analysis behind all of it. And we still have a discount coupon code. It's May Day that is still active if you want to try it out. 50% off the first month only for a monthly membership, and a larger discount for those interested in a yearly membership. So coming down, we've got the SPX monthly, and this guy says we might still have some 9 to 10 years for the next big top to be formed in the S&P 500 index. Well, what I would say here is I think a lot of this is driven, some of these consolidations sideways were inflation expansionary phases of real estate. So I think it depends what comes up. I'm in the camp that we'll probably go sideways and put one of these patterns in, like the 60s, 70s, and potentially the early 2000s. The reason I think that is the case is because we are in an expansionary phase of real estate. And during those periods, we generally get higher rates of inflation. Interest rates go up, which they already kind of have to some extent. And then they stay elevated and the stock market trades sideways. That's what we've seen in history. So if you were to overlay the real estate cycle on top of this, you'll see a pattern where you get a cycle sideways, up, sideways, up, sideways, up, sideways, up, like that. Now, the one thing I don't know, and I'll admit this, is did the stimulus money that was introduced into the markets in 2020, did that cause a false breakdown here for that COVID crash, number one? And then number two, were interest rates raised naturally by the markets, or did they raise them because of the stimulus money that went into the markets? And did we raise it too much where it might have slowed down the housing market, which is the generator of that inflation? Most of it, at least in history, it was. So we'll see. We'll see what occurs. We've got people who succeed in the stock market also accept periodic losses, setbacks, and unexpected occurrences. Calamitous drops do not scare them out of the game, says Peter Lynch. Yeah, having some setbacks is expected. How big they are and how long they occur. A lot of people worry about the pullbacks. They worry. They try to time the market, sell if there's a pullback. They get emotionally charged, sell their portfolio, change their mind, switch it up. They do all sorts of stuff in the short term. That does lower your returns. Messing with your portfolio like that, especially when you're emotionally charged, generally is a negative to the performance of the portfolio. You almost have to do opposite of your emotions. When you get fully emotionally charged, it's probably a good time to buy. And when you get a little bit too excited about the stock market and everything's going up, it's generally a good time to just hold. So we got Tavi here. The rise in unemployment rates yesterday highlights the critical importance of this macro signal, which has consistently predicted severe downturns in the labor markets. If history is any guide, this is the beginning of an upward trend in unemployment rates, not the end of one. You know what else goes up with unemployment rates? Gold and silver do. I don't know if you guys know that. That's that uninversion of the yield curve. So if this is going on up and we get a slowdown in the market, I would suspect that they would lower rates. We could get an uninversion of the yield curve, totally possible. And maybe we go through a slowdown, very possible. Now, if we see that uninversion, we should see the 2-year yield drop. We should see this unemployment, says times when unemployment rate crossed above its 21 or 24-month moving average, it looks like. But when this goes, that's generally the beginning of a potential slowdown. The red lines here is the times when unemployment rate surpassed its 24-month moving average, which almost every time we get these slowdowns. So are we in a slowdown? Are we entering one? We'll find out. Research builds conviction. Conviction enables patience. Patience builds wealth. Yeah, that's pretty well said. If you don't have conviction, you're just going to sell out. I totally agree. And patience is really the name of the game for making big amounts of money. You have to be in it for a while, and that requires patience. And patience does require conviction. So it makes sense. And building lots of wealth requires patience. Makes sense. Here we've got all there is to investing is picking good stocks at good times and staying with them as long as they remain good companies. Yeah, it makes sense too. Warren Buffett he doesn't really play the commodities game as much, but he chooses the companies that really can't go out of business due to, say, like technology companies that get cycled through. Something new comes out, the old ones get cycled out. He likes the ones that like they don't change the business model really. Technology improves the company, but they don't change the company. So insurance companies, food products, beverages like See's Candy, Coca-Cola. I think he's been in McDonald's and Nike and stuff like that. Overall, at some point over the years. So he likes those types of companies, ones that kind of don't go out of style. They just ride it, and if there's more population on the earth, they benefit from it. Here's another one from Howard Marks. Psychology swings much more than fundamentals, and usually in the wrong direction or at the wrong time. Understand the importance of resisting those swings, profit from it if you can by being counter-cyclical and contrarian. So if you can psychologically handle those market sentiment swings, it's best to profit from those negative swings and buy and then kind of hold on during the big upswings. Calvin says the difference between people that become really wealthy as investors and people that grind at it like it's a 9 to 5 is time horizon. If you want to be rich, think 5 to 10 years out. Short-term thinking will keep you poor. And I agree with that. You position and you hold for the cycle, and the cycle doesn't play out completely until about 10 years. So, and some of the stocks, it takes even longer. Like you can hold them for 40, 50 years like Warren Buffett does. Those ones that are boring and they don't really change their business model, like health insurance, credit cards, fast food, etc., etc. When in doubt, zoom out. Gold retains uptrends across the board via a 3% box size. The minimum trend following increment in my work. So this is gold on a point and figure chart. Nice little break here above this resistance area. Gold versus the S&P 500 looks like it wants to break out of a consolidation. We've got gold versus the CRB index that looks like it wants to break upward and about to break out of a consolidation. And gold versus TLT, that's already running. What would cause gold to go up? This right here. When unemployment rate crossed the 24-month, when this goes up, gold generally goes up with it. When the uninversion of the yield curve that's when gold starts to really take off. And I think, maybe those market conditions are coming sooner than I think, even. It says the markets are a classroom where lessons are taught every day. The keys to investment success lie in observing and learning, says Howard Marks. Henrik Zaberg, he says, for all of you that see no recession and new economic expansion, what are you looking at? How much clearer do you want it? The economy is deteriorating and a recession will set in late 2024. This here is the civilian unemployment rate, much like Tavi was talking about. And he says whenever it crosses this 0.1 line, we usually get a recession. So cross recession, cross recession, cross recession, cross recession. We're crossing it right now. Are we going to get that recession? We could. We could. And what is that recession going to look like? I don't know. We'll find out. But we could. And, some people will say, well, what do I do? Well, I mean, if you're worried about a recession, I would basically stack some cash in case we get a pullback. If we get a pullback, consider yourself lucky and buy the cheap shares. That's what I would do. How many commodity companies can you spot? And this is the largest companies by market cap. So when looking and going through this, there's Chevron here, commodity company, going on up. We've got, none of these are commodity companies. Chevron is the only one. I didn't even see ExxonMobil. Is Chevron bigger than ExxonMobil? Oh, yeah, but that's all we've got on the list is one commodity company. Everyone else, yeah, one energy. Oh, here's ExxonMobil right here. So we've got Saudi Aramco's up here. We've got ExxonMobil and we've got Chevron. So there's three commodity companies on this list. So not too much, not too many commodity companies occupy the top largest by market cap in the world. Logan says, not many people remember housing was booming in the 1970s with sales and prices. And that was that slowdown. So I just was kind of looking. Here's a spot I didn't realize how much of a boom we've had here, guys. Look at the 40s. Holy crap, that was a big housing boom. 43, 44, 45, 46, 47. And that's your big winner's curse at the last 2 years here. Then we went into a slowdown in 48, 49, 50. We kind of slowed down some. Then we started picking back up a little bit. 51, 52, and 53 was a big year. And then another slowdown in 54 and 55. We didn't have too much home price appreciation in the 50s. Then it sped back up in the 70s here. 69 was 7%, 8%, 4, 3, 3, 10, 7, 8, 15, 16, 14. And then we had a slowdown in 1980, 81. You can see that we had a slowdown in housing, but it didn't decline. It just was going up. We had a decline in 1990 of 1%, and 91 we had 0% gain. We also had a pretty big pullback in 2007 to 2011. Big decline in real estate. And there isn't really too many declines outside of these two red areas. And this isn't really a big decline. It's basically just moving sideways. So we've only had, since 1942, one area that we've declined in housing. And a lot of people are calling for this great crash in real estate. And where the historical crashes were they didn't really exist like these people are calling for. So coming down, we've got break wave, danger ahead. Weather forecasters predict a very active hurricane season. The U.S. oil industry employs many crude oil and product tankers, both importing and exporting oil. Hurricanes can cause increased volatility due to the dislocation of supply and demand. Initially, rates could be depressed due to an oversupply of ships, but this is often followed by a rate spike as supplies need to be replenished. In any case, oil companies and ship owners need to be prepared for this potentially active hurricane season. Josh Young, and I agree with what he's saying here. He said, this was odd. Who sold 150 million barrels of oil this past week in the futures market? And why did they do it almost all at once? And it says, did something happen in the oil markets around 8 a.m. EST this morning? Asian and European markets priced the OPEC Plus meeting and weekend data neutral to positive. Then when the U.S. market opens and the UTI oil price falls 3.5%, it is odd. Yeah, what is going on here in the oil market when they open it up in the morning and then just a whole bunch of barrels get dumped, paper barrels, all at once? Whatever. Whatever. That's all I'm going to say is whatever. It seems kind of weird. It says this is a scary chart. Treasury bond issuance this year is expected to increase to 1.9 trillion, surpassing even the 2008 peak of the financial crisis. So here's the financial crisis. I mean, we've been issuing bonds like no other. Look at this. I mean, 2020, no, but look at that. That's crazy. Gold, silver, commodities. He says, I think it's fairly obvious something big is going to happen on the world stage very soon. This weekend or early next week, the playbook is always the same. Smash the price of gold and silver before something major geopolitically happens, keeping the initial rise manageable. Why do they do that? And I've got another chart below showing you what that looks like graphically. So here's Tracy. She says Warren Buffett's Berkshire Hathaway buys an additional 2.57 million shares of Occidental Petroleum, shows the SEC filing. Berkshire Hathaway purchased an additional 2.57 million shares of Oxy's common stock between June 5th and June 7th, according to the U.S. Securities filing. The investment amounts to over 150 million, increasing Berkshire's stake in the company to about 250 million shares. So he's out there buying some oil companies. I would be too, is what I'll say. It says, what a massive wick. That's what she said. Jokes aside, what are the odds of GME gets back below 24.25 and stays below before June 28th close? And this is GameStop semestrial log chart. And there's that big nose. It says noise from the smaller time frames. It also indicates you got some selling pressure in the stock. Those big wicks at the top. So kind of interesting looking chart here. It does look good though to potentially go on up. What are 100 years among friends? So the top 10% of stock by size versus the entire U.S. stock market. And the top 10 right now is one of the highest periods, much like 1929 and the year 2000. So what makes these all similar? 1929 or 30 or wherever that is, 29, 30. We've got 2000. So bubble, and do you think this is a bubble or not? Is this a bubble or not where we're at? Do you think this is going to continue to go up, or do you think it's going to roll over at some point and be a bubble? I'm in the rollover at some point here. But that's me. I think the valuations are not good. Big picture, big opportunity. $370 an ounce silver is the minimum price target. Jesus. And look at this move he's got on this logarithmic move. We got this nice breakout of the cup and handle. It's ready to go, guys. It's ready to go. He says, his words, price target of 370 could also go much higher briefly at the end of the bull market. He's talking about the Kondratiev wave high and low. The chart shows the largest so-called long cycle I track, the Kondratiev wave. The Kondratiev wave is this KWL, the low, and then KWL is the high up at the top here. So we could have a big blow-off move to the upside of this Kondratiev wave. What he states is, possible time span for the fifth K wave for the top is between 2028 and 2040, in his opinion, for this big Kondratiev move. He says the fifth Kondratiev wave, K waves, have lasted 54 years on average, in his opinion, or just on average of what the data is. So that's interesting. B of A Hartnett says zero risk premium in the crude oil market right now. So zero risk premium. This is oil versus gold, and this is oil divided by gold price relative, and we are at a very, very low price here, guys. Very low price. Now, this is a very high price. Last commodity bull market, energy from 1999 went into a bull market and stayed at a very expensive level for the entire bull market. To me, this looks like a shoulder, a head, and a shoulder. We're scribing out the right shoulder right now of a bottoming pattern in this ratio chart where we could turn it and go back up, where oil is going to outperform gold. And I think what's going to occur, or what could occur, maybe not what I think is going to occur, what could occur is that we could get a right shoulder that comes all the way down to here. We get that yield curve on inversion, a slowdown in the market, and then they pump the system with a bunch of money and they send oil to the moon. That could be a potential possibility, maybe. It says on average, the S&P 500 SPX has fallen 23.5% over a period of 195 days from the first Fed cut to the market low. Keep this in mind when the Fed finally decides to start cutting. So here's the cut cycles, and these are the average is 195 days and minus 23.5%. It's the average from the first Fed cut to market low. And just keep that in mind. So the last three significant lows for gold futures fell right on the non-farm payrolls report. Sometimes they do ring the bell to feed the pigs. Ascending W formation still underway, and if the activated targets we get 2850 to $3,000, the old is passing away. So those are those non-farm payroll, and we get these big selling pressure moves by them. Why? Like, why are we getting these big dumps around non-farm payrolls? Weird. So I'm going to read this thread here. It says, it took me 9 years to realize, and I will tell you in 2 minutes. So here's the things that he realizes. Don't tell them everything, even when you trust your close friends and family. Don't tell them everything. You can never expect honesty from people who even lie to themselves. You'll be 10 times happier if you forgive your parents and stop blaming them for your misery. Free yourself from society's advice. Most of them have no idea what they're doing. I like that one. If you continue waiting for the right time, you'll waste your entire life and nothing will ever happen. Your current job doesn't care about you. You only get paid enough to kill your dreams. You'll lose 99% of your close friends when you start to improve your life. You don't need 100 self-help books. All you need is action and self-discipline. Your marriage partner remains to be your greatest financial, physical, and emotional decision. If you marry wrong, and you'll suffer forever. Well, maybe not forever, but YouTube, podcasts, and the internet will make you learn 10 times faster than a 4-year college degree. It's better to have one friend who's happy for you, supports your win, and encourages your dreams than a bunch of acquaintances who are selfish, lazy, and jealous of your success. The ultimate flex is acting broke while your money works for you. Yeah, that's what I do. Maturity is admitting you know nothing and learn from everything. Train yourself to let people intentionally win arguments to conserve your mental peace. Skills in financial education will make you win over 97% of the college graduates. Yeah, I think financial education is a huge one. I do think that. So let's go back. We've got Eric Nuttall here. He says, breaking net oil length. The financial demand for oil just hit its lowest level in at least 13 years. Epic divergence between financial and physical oil markets. And with a 30 to 50x size difference, the CTAs and algos are winning for now. It all comes down to summer draws. and we'll see what occurs this summer. And that's where I'm going to end it, guys. So that's what I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you're interested. We still have that Mayday coupon code. And that's all I've got for today, guys. So we'll catch you later. This is Finding Value.